Repeating podcast. Usually, the one doing this is a man named Yash or Hardik, and both of them won't be joining me today, so it's just going to be me, Ayush, serenading or monologuing you for the next 10 to 15 minutes about quite an interesting topic. But before we begin any of that, I'd like to give you a short disclaimer that none of the securities that I mentioned during the course of this podcast is recommendatory in any manner. None of it is financial advice. And most of the numbers that we've used during the course of this podcast are historical or current figures. And any projections or valuations that we give you are purely for an educational standpoint and just to give a sense of how the industry or the stock that we're talking about may perform. So none of it is advice and none of it is factual on that sense. Okay, we can begin now after all that's done. We're talking about internet stocks today. So an internet stock is basically any company that has developed enough tech to be able to disrupt a brick and mortar business into a tech driven one. Now this could be anywhere from Zomato, CarTrade, Nykaa, all of which have disrupted one or the other brick and mortar business. Now, VCs or venture capitalists have been gaga over all of these stocks for the past few years. In fact, I have some numbers here to show you that in 2021, India ranked among the top 5 countries to attract the most amount of VC funding for startups. So, to give you context, there were about 1,715 deals that were struck in 2021, worth about $34 billion. And that number is a historic one for India because it was 4 times the previous high which happened in 2020. And that's where we've peaked as of now. And obviously, a lot of these VCs funded late stage startups that were already either bootstrapped before or funding before, or they were doing really well and they were in the media for being disruptors in their specific fields. And push comes to shove, most of these end up listing as a public company. And that's what happened in 2021, where a bunch of these companies like Zomato, CarTrade, Nykaa, Policybazaar, Paytm, all of these listed consecutively in a few months span. Unfortunately, that fame and hype that was surrounding these companies was pretty short-lived because post-IPO, none of these companies that I mentioned earlier have hit their IPO prices. For numbers, Zomato listed at 116 and is now at 62. Similarly, companies like Zomato, CarTrade, Nykaa, Policybazaar and Paytm have all fallen from their IPO prices by a range of, let's say, 45% to 80%. And it doesn't show any sign as of now to come back to those levels anytime soon. So investors got a pretty raw deal, but the ones who did do well are the ones who invested pre-IPO and got their exit during the IPO. There could be other reasons, of course. There was just global macroeconomic tension that was going on at the time in 2021, and there's this correlation that has been seen historically between the US markets and the Indian tech markets. So if one falls, the other will, and usually US would be the leading indicator and India the lagging. And funding in the VC space also declined year on year. In fact, it dropped by about 38%. So the number of deals increased, but the total value of those deals have fallen. And the investment into late stage startups like those have fallen by 50%, where VCs are going towards more early stage startups which are just finding their product. Seems like a safer investment, at least compared to what these guys faced. But even though we've trashed all of these stocks in the span of the but even though we've trashed all of these stocks, there seems to be one that might actually do well and has been doing well, but has been bludgeoned the most in terms of falling stock price. That is CarTrade Tech. We'll come to why CarTrade Tech sounds like just a good business to study, look into, and why they seem to be doing well, but why their stock price did badly anyway. But let's first get out of the way what CarTrade actually does. So CarTrade Tech may not be as famous as possibly the websites or the companies that come under the CarTrade banner, which is Carvale and Bikewale. Now, these will be some of the first few websites that you will see on Google when you want to sell or buy a used car or just get connected to buying a new one and want to do your research beforehand. Okay. So now that you know what CarTrade is in the field of, let's try and figure out what the business does. So I have a nice little table here that you can check out from our blog on our website, repeating.com. but just for now, I'm going to read it out to you. So there's three models basically. There's a subscription model. Now in that model, used car or new car dealers pay CarTrade a specific fee per month. So that could be anywhere between 2,000 to 10,000 rupees. And that gives them the ability to reach the customer or just get leads from the people who actually visit the website. So that subscription is for the dealer to be listed onto the various websites that CarTrade owns, and for those dealers to be connected to the customers like you and me who wish to buy their cars. So that's one form of revenue that CarTrade has. The other, which is quite a major one, is advertising expenditure. Now it's not their own, but it's car manufacturers and other dealers who spend a significant part of their advertising or marketing budget and spend it on companies like CarTrade to promote their vehicles or launches. Now, for example, most recently, if you had checked out any car wale or bike wale websites, the top will show a few promoted cars that you should be looking out for. That should entail that those companies have paid a premium and wanted you to see those. That's a major source of revenue for CarTrade, and one that seems to be growing. The third, and which is quite a recent one because it is part of an acquisition that they made in 2018, is the auctions business. And that's basically when used cars or repossessed cars. Now, go and take a loan to buy a car, and you are unable to pay that loan within the first 1 or 2 years, and you default on the loan eventually. The bank or the financial institution that you've used to get that loan will hardpofy the car. So these repossessed vehicles cannot be obviously held by the bank, and they want to recover their loan amount, so they're going to sell it or auction it off. CarTrade acquired a company that does this and is in fact one of the largest ones to do it in the country. So that's your three forms of revenue. Now we'll get into why and how the industry will be favoring the segments that CarTrade is in. Okay, so now that we're getting to the industry dynamics and what kind of factors could lead to CarTrade growing even more from now onwards, and of course, these are deductions off of projections, some of them, and some of them are just intuitive learnings from how the industry's performed in the past, what kind of changes could be made in the industry in the next few years that could help or benefit CarTrade. The first one being a growing digitization movement. Now, from less than 2% of cars being sold digitally in before 2019, that number is now 10%. So that's quite the gap, or quite the now that's quite the increase. And there seems to be a growing demand for people who want to buy their cars online, or at least do most of the work online before actually getting the car. In fact, 90% of cars being sold now are digitally driven. Yeah, so digitally driven basically means that all of the research, all of the contacting, all of the booking of test drives, and financing of the vehicle, buying insurance, anything except for testing the vehicle and actually getting the vehicle, all of it is being done online. And CarTrade obviously is one of the largest players that could benefit from this growing trend. Now, with so many users, now let's get to how many people actually visit these websites. So for CarTrade specifically, they have a run rate of about 3 to 3.4 crore monthly unique visitors, which basically means if one visitor clicks on the website about 5 times, that's one unique visit. But anything more than that, it's considered a repetition. So 3.4 crore people are visiting the website uniquely every month, and 86 to 88% of that is all organic, which means they aren't paying for ads or marketing campaigns to get 86 to 88% of that traction. So that's a great metric, and is one that they flex on most of their quarterly disclosures. With the growing digitization also comes growing digital ad spends. When we spoke about advertising expenditure from car manufacturers or dealers, this is where that comes in. Now, a growing percentage of the total advertising budget is being used towards the digital endeavors. Let's say, for example, a few years ago, less than 10% of the budget was used towards digital spending or digital ad endeavors. Now that has gone up to about 25% and is expected to grow to about 40% by 2027, just by looking at how the trend is moving and how people are moving towards the more online way of dealing with even car purchases now. So it makes more fiscal sense and even marketing sense to spend more on this segment rather than the print media that was the usual norm. Coupled with the fact that Cartrade actually has a 5 to 7% market share in this auto classified space, they're bound to benefit from it if this pans out. Next reason why Cartrade could do well based on just industry dynamics is the rising demand and rising supply of used cars in the auto space. Now, used cars, of course, second hand, third hand, that people buy at a much lower cost is seemingly a better financial and just a better car decision to make now, especially among millennials, because most of the used cars that are being bought right now, 80 to 70 to 80% are being bought by millennials of the country, and most of them actually first time purchases. Obviously, I mean, it makes sense, it's cheaper, the maintenance wouldn't be as much, and anyway, the life cycle of a car holding period has gone down from, let's say, when our parents were younger, they used to hold on to a car for 10 years or more. Now it's barely 5 years or lesser. So that transition is happening where people are holding cars for much less and then change their cars. So it just makes better financial sense to buy a used one rather than spend exorbitantly on a new one. Now, this segment is set to grow at around 15 to 17% compoundedly over the next few years till 2027, while the new car segment is growing at about 10%. So clearly the used car market, and this is of course projected on the basis of how historically the used car market has grown, and it has historically, and it may future, and it may also in the future grow at a faster rate than the new cars. Now, why Cartrade benefits from this? Because they have a 60% market share in the online used car segment as well. And that's also because of an acquisition that they made, which we will come to later. But this cumulative entity has managed to grasp 60 to 70% of a market share in the used car space, which means it will eventually become one of the largest entities to provide used car supply and have one of the largest base for used car demand as well. Reason, and one that you may not have guessed as yet, but there is a bit of a car dealership crisis happening in India. Now, to set up a car dealership, it takes about 1 crore to just buy the property and then get 1 month of inventory. Now, this could be 10 or 20 cars a month based on the average that an Indian car dealership sells in a month. But just to get that much, it's 1 crore investment straight up. And that's something that most people can't afford, especially when the Indian car dealership business is so low in margins, which is just a 4% margin on selling a car and 15% margin on selling your spare parts and everything. Whereas the global average, or let's say comparatively larger auto markets, since we are among the top three, comparing to let's say China or the US, the vehicle based margins are north of 7 to 10%, and the spare parts margin are actually 30% or more. So clearly there's something going wrong. Obviously the investment isn't being able to be recovered as quickly, and dealers are facing a crisis. More than that, dealers are forced to stay within their localities or sell within their localities because they're bound to that particular location, and they're not able to fruitfully take advantage of digitization yet. So Cartrade has come up with quite the initiative and a new business segment that they have been building over the past 3 years called AbSure. Now, AbSure is just a portmanteau for absolutely sure. And of course, it's quite the lame name, but it is a company, or rather a segment, that is going to take on this dealership crisis and help the dealers, of course, rather than just capitalizing on their pain. So instead of buying all of these outlets and buying the inventory, I'm sure under Cartrade is going to be leasing outlets. Now, when they started off, they probably had 20 to 22 outlets in the first 1 or 2 years. And now 3 or 4 years later, they have about 100. So that's quite the growth rate, and none of it is bought. It's all leased, which puts a lesser load on the balance sheet and lesser load on just a depreciating asset. So their fixed assets are low in this regard. That's a good thing. On top of that, AbSure doesn't really buy the inventory. They're just connecting the used car dealers or the new car dealers through AbSure to the customer. So the inventory is not being held by Cartrade, which is again a good thing because it's not a drain on them. In fact, the used car dealers actually have to pay Car Trade a parking fees to keep their fleet of used cars in the AppSure outlets. So that's another smaller, very insignificant source of revenue, but one that's coming in regardless. Now, what AppSure actually provides is inspection of the used cars. So there's like a seal of guarantee that Car Trade puts on these used cars. So you know that even if you may not trust the dealer because they're local, or they may not be, even though you may not trust the dealer, you have you even though you may not trust the dealer, the transparency that Car Trade will be showing you through this guaranteeing process and inspection and valuation process of the car, you will be more inclined to trust the brand. Apart from that, they provide a 1 year warranty, they provide financing opportunities because they've partnered with IDFC First, and some insurance benefits as well. So they're giving you a huge package deal, and they're able to increase the margins on this dying business by, so let's say it's an average of 3 to 4%, they're going to bring it up to 7%, which is not a bad deal at all. So now that we've spoken about their business model and what could work for them, there were a lot of people who, when we were discussing and researching this firm, that brought up a US firm that's similar and listed in 2017 called Carvana Co. Now, they're quite a unique business if you think about it, because they are the exact opposite of whatever Car Trade is doing. But they just started sooner in terms of their listing journey on the exchange. So Carvana basically buys the inventory off of these dealers or off of whatever their source is, and then gives it direct or sells it directly to the consumer from their end. So they hold the inventory, they buy it, so it's inventory being held on their balance sheet as well as physically, and they sell it to these consumers via a website. Now the unique part is they have bought out these massive car malls where it's a vending machine for cars. I should put up a picture right here for you to see what it looks like now. Can you see it? Okay. Yeah, so basically that's a car mall. That's a car mall where you get a token, and based on whatever prior purchase you've made, you get a token, you put it into sort of a vending machine system, and the car is given to you. Although that sounds extremely cool, and it worked really well during COVID because no one wanted to, everyone was into the contactless transactioning. Post COVID, that didn't really work out, and now currently they're in insane amounts of debt, more north of $7 billion, while their cash reserves are barely around $320 million. That's quite the gap that they have to cover up, and a lot of industry reports and just people, veterans of the market, believe that the company might just file for bankruptcy. As a stock, also, they've had a horrible journey because they listed around $11. They reached a peak of $360, $370 in 2021. So from 2017 to 21, that's the journey they've had, from 11 to 360, and now they're back at $10. So it's in fact one of the most shorted stocks in the US history. So you should go check it out, go look into the stock, see why it's interesting, and see why Car Trade is the exact opposite. So not only does Car Trade not do the whole fixed asset and buying and holding thing, they're very asset light on their balance sheet, but they don't deal in debt. Car Trade is completely net debt free, while the only liabilities they have are the lease liabilities because of all the outlets that they are renting or leasing out. And they have a massive cash reserve of 1100 crores rupees, of course, 1100 crores, which is 50% of their entire market cap. That entails a brilliant position to be. So they're much safer in that comparison, and they are the anti-Carvana if you want to think about it. Also, since we spoke about Carvana doing a bad acquisition, Car Trade is extremely good at acquisitions. In fact, acquisitions is in their blood because they've not stopped acquiring companies since they've started. So in 2009, and I think this is a little less known fact about Car Trade, but they started off as a company named Motor Exchange, which was a used car exchange platform, of course online. And within weeks of starting this company, they acquired Car Trade India, which was another competitor in the same field, and they combined it to form Car Trade Exchange. That was in 2009. After 2012, they bought out Carvali and Bikewali for about 570 crores entirely. So that part of the business where auto classifieds, ad revenue, website related stuff comes in there, where they do just listings of cars and expect the OEMs, which are the manufacturers, to pay them for advertising their vehicles. So Carvali and Bikewali was also an acquired business. Got to a few years later, they bought this company called Adroit, which is a company that does inspections and valuations of cars, which is a feature that will play into their AppSure business and even in their auctioning business. After 2018, their most recent acquisition was a company called Shriram Automall, and this is what I was talking about much earlier as well. This is the company that was the largest used car auction space or repossessed car auction space in the country. So their combined entity has created a mammoth of a company, giving competition to various unlisted players in the space because Cartrade is the only listed one, of course, as of now. Yeah, so they've had a history of acquiring businesses, especially in all cash. Most of their deals are majorly cash component based and then turning them around into profitable or at least revenue generating businesses for themselves. Now, as I mentioned, 1100 crores in cash. What are they going to do with it? So they've created a venture fund worth 750 crore called Car Trade Ventures. Quite the innovative name. But they intend to continue this acquisition spree over the next few years and acquire companies that just fit with Cartrade's ideology. One of them that might be in the talks is Go Mechanic. So now you may have heard of Go Mechanic, and they're probably an infamous name that you may have heard of because they're involved in a lot of corporate governance nonsense, whether it's fudging their numbers, firing 70% of their workforce, or just not paying their vendors on time. And this could be a tricky investment from Cartrade's perspective because the previous ones have not been bad companies before them being acquired, but Go Mechanic clearly from a factual standpoint is just a bad company. But if Cartrade is able to buy it at quite the reasonable valuation and then turns it around into a profitable bit for their AppSure business or anything where they provide in-house servicing of cars, then Go Mechanic could become an integral part of Cartrade's journey, but that is left for us to see if this acquisition even works, and if it does, how Cartrade manages to turn this company around and its image around. Now let's talk about the profitability bit. Now we've flexed that Cartrade is the only profitable company in this entire line. So whether it's Cardeco, Cars24 or any of those other players, Cartrade is the only profitable player as of now, and that's on a historical basis as well. So I have some numbers for you on the profitability bit, and of course you can find this again on the blog, but I'm just going to read it out to you. The company has displayed steady revenue numbers despite COVID. So in FY19 they had about 266 crores, and FY23 they have 425 crores. That's about a 10% CAGR or compounded annual growth rate over that 5-year span, which is great because despite COVID happening and people not really buying cars during COVID, they managed to retain or at least have a steady industry growth related number. But that wasn't the only factor that played into them being profitable, of course, because not only, as we mentioned, asset light, net debt free, huge cash balance. So that all played into just their improvement in margins, where their EBITDA margins went from about 17% in FY19 to 23% now in FY23, which is quite the drastic increase, and it's been increasing regardless. And their actual profit numbers or profit after tax numbers went from 29 crore in FY19 to about 41 crores now. They did have a loss in between, so full disclosure, but they managed to recover and they're on a trajectory for better things, hopefully, if the company does well. So there were few things going on for them, and if the industry is in their favor, they will continue to do well in those things and possibly better and improve their numbers. Why is someone calling me right now? This is what happens when you live at home. Yeah, so now that we've established that Cartrade has a few good things going on for it, despite the massive bludgeoning of a 74% decline in their share price. So whether it's their subscription model based revenue, their ad based revenue, their auction based revenue, or their newest addition, AppSure, which is their dealership for used cars based revenue. So they have a few of these segments going, and if the industry plays well in their favor, then those will continue to do well and hopefully improve their numbers. But of course, anything is possible in the market, and these are all just views that we're giving in a particular scenario and none of it's advice. But since we've already spoken so much about the positive, let's talk something about the negatives. Now, the 750 crore venture fund that they've created could be quite the risky investment, because out of the 1100 crores, if they're setting aside 750 for acquisitions, and if any acquisition goes bad, that money is gone down the drain. The other reason could be that their IPO wasn't really an IPO, and that really played with investors' psyche, because the IPO was actually something called an offer for sale, where their previous pre-IPO investors and promoters got an exit out of the company for a much higher valuation, and hence the steep plummeting, because those valuations were clearly unfounded and not based on fundamentals. Now that we've already spoken vastly about the fact that they have 1100 crore cash balance, which is amazing in itself, the source of that cash balance is mainly from their venture capitalist and private equity funding that they've received over the years. Now it's only logical for them to not uh, spend that money on investors, whether that's through giving the investors a dividend or engaging in a buyout, which could possibly lead to some share appreciation. But the VCs obviously wouldn't be too happy, because their expected return on most of these deals are anywhere between 30% or more. Giving investors back their money isn't really on a VC's agenda. They would rather spend that money and burn it in the form of acquisitions or just business expansion. So all of that capital, or all of that fund that they have left, the possibility of it coming to an investor is unlikely. So after all this, since we are technically a research-led firm where we do everything, we've also done a valuation, and of course this valuation has no bearing on how the performance of the stock will actually pan out. It's just our view, and a view that we're doing from an educational standpoint only, just to show you how we could compare or value a company like Cartrade. So we've done something called a discounted cash flow. You can obviously check out what a discounted cash flow is and then come back to this video, where we've expected their revenues and PAT figures to grow by around 15% and 20% respectively over the next 5 years. It gives us a value of about 580 rupees for Cartrade. They're currently at around 420 rupees. Yeah. So that gives us the possibility of a 38% upside if that price target is met. Now again, coupled with the fact that there are so many good things that could go right with Cartrade, cash balance, their good business, their profitability, uh, the propensity of them doing well after such a large decline is fairly high. So we found Cartrade quite interesting, and we think you should check it out too, see what you feel about the stock, and then come back and comment whether you agree with how we think Cartrade is going to pan out or not. Until then, thank you so much for watching, and please tune in the next time. Hopefully I will have someone in the vicinity of me so that I don't act as awkward as I have in the past 15 minutes or 20 minutes, however long this podcast is going on for. Anyway, thank you so much and take care. Bye.